Did you know that making the wrong decision about your Social Security benefits could cost you thousands of dollars over the course of your retirement? Many Americans unknowingly make mistakes when it comes to claiming Social Security, and these mistakes can have long-term financial consequences. In this video, we're going to discuss some of the most common mistakes people make with Social Security and how you can avoid them to maximize your benefits. A lot of people assume that as soon as they turn 62, they should start collecting their Social Security benefits. After all, they've worked hard, paid into the system, and now it's time to reap the rewards. But what many people don't realize is that claiming Social Security early permanently reduces your monthly benefit amount. If you start collecting at 62, your monthly benefit could be reduced by as much as 30% compared to waiting until your full retirement age. This reduction lasts for the rest of your life, meaning you could lose out on a significant amount of money over the years. If you can afford to wait until your full retirement age or even until age 70, your benefits will be significantly higher, and you'll have more financial security in your later years. Think of it this way: would you rather get smaller checks for a longer period or bigger checks for the rest of your life? Many retirees regret taking their benefits too early when they realize how much more they could have received by waiting. Another mistake many people make is failing to check their Social Security earnings record. Your benefits are calculated based on your highest 35 years of earnings, but what if there's a mistake in your record? If an employer failed to report your income correctly, or if there was an error in how your wages were recorded, you could end up receiving lower benefits than you actually deserve. Imagine working for decades, only to receive less money than you should because of a simple reporting error. The Social Security Administration allows you to review your earnings history on their website, and it's crucial that you check this regularly to ensure there are no errors. If you do find a mistake, you can report it to the SSA and get it corrected before it impacts your future benefits. Many people don't realize that working while collecting Social Security can reduce their benefits, depending on their age. If you begin collecting Social Security before reaching your full retirement age and continue to work, the Social Security Administration has an earnings limit. If you earn above that limit, your benefits will be temporarily reduced. However, once you reach full retirement age, those deductions are removed, and your monthly benefit amount is recalculated to account for the amount that was withheld. If you plan to work while collecting Social Security, it's essential to understand how the earnings limit works and how it could impact your benefits. Here's an example. Let's say you start collecting benefits at 62, but you also work part-time and earn above the Social Security earnings limit. You could see some of your benefits withheld, which might not be a big deal if you're financially stable, but if you're depending on every dollar, it could be a major setback. A common oversight among retirees is failing to take advantage of spousal benefits. If you're married, you may be eligible to receive Social Security benefits based on your spouse's earnings record instead of your own. In some cases, claiming spousal benefits can result in a higher monthly payment, especially if your spouse was the higher earner. Spousal benefits can be up to 50% of your spouse's full retirement age benefit amount. However, if you claim spousal benefits before your own full retirement age, the amount you receive will be reduced. Understanding how spousal benefits work can help couples maximize their total household Social Security income. Let's say your spouse had a much higher income than you throughout your career. Instead of relying on your own benefits, you could claim a higher amount based on their record. Not knowing this could mean leaving free money on the table. Many retirees are surprised to learn that Social Security benefits can be taxed. If your total income exceeds a certain threshold, up to 85% of your benefits could be subject to federal income tax. This includes income from pensions, withdrawals from retirement accounts, and other earnings. The income threshold varies depending on whether you file taxes as an individual or jointly with a spouse. Planning ahead by working with a financial advisor can help you minimize the tax burden on your Social Security benefits and keep more money in your pocket during retirement. A quick tip: if you have a 401(k) or IRA, consider strategic withdrawals before claiming Social Security to lower your taxable income later on. Every dollar saved is a dollar earned in retirement. Another mistake that some people make is assuming that Social Security alone will be enough to cover all their expenses in retirement. While Social Security is an important source of income, it is designed to replace only about 40% of the average worker's pre-retirement income. That means most people will need additional savings or income sources to maintain their standard of living. Creating a retirement plan that includes other sources of income, such as a 401k, IRA, or other investments, can provide financial stability and ensure you have enough money to cover all your expenses. Here's something many people don't realize: healthcare costs in retirement can be huge. Medicare doesn't cover everything, and out-of-pocket expenses can add up quickly. If Social Security is your only income, you could struggle to pay for the healthcare you need. It's also crucial to consider the impact of inflation on your Social Security benefits. While Social Security does offer cost of living adjustments, they may not always keep pace with the rising cost of healthcare, housing, and other expenses. Retirees who rely solely on Social Security may find that their purchasing power declines over time, making it harder to afford basic necessities. Having additional savings and investments can help protect against the eroding effects of inflation and provide greater financial security. One of the biggest mistakes people make is not planning ahead for Social Security. Many individuals wait until they are about to retire to start thinking about how and when to claim their benefits. However, planning in advance allows you to explore different claiming strategies and maximize your benefits. Whether it's delaying your claim, coordinating with a spouse, or considering tax implications, taking the time to plan ahead can make a significant difference in your overall retirement income. Social Security is one of the most important retirement benefits available, and making the wrong decisions about when and how to claim it can have lasting consequences. By understanding these common mistakes and taking steps to avoid them, you can ensure that you maximize your Social Security benefits and secure a more comfortable retirement. If you found this video helpful, be sure to like and subscribe for more Social Security tips and updates. And let us know in the comments, have you made any of these mistakes, or do you have any questions about Social Security? We'd love to hear from you.